Welcome back to Wisemoney, the podcast dedicated to helping you master your finances, build lasting wealth, and achieve true financial freedom. In our last episode, we talked about building your financial foundation, that crucial emergency fund. Today, we're going to dive into something even deeper, something that often dictates whether that foundation stands strong or crumbles under pressure: the psychology of money. You see, money isn't just about numbers, charts, or economic indicators. It's profoundly personal. Our financial choices are often influenced, subtly but powerfully, by our deepest beliefs, ingrained habits, and even irrational fears. We are going to explore the psychological biases that can lead even the smartest among us to make incredibly poor financial decisions. By understanding why we do what we do with money, we can begin to overcome these subconscious barriers and make wiser choices. Let's start with a big one, a bias that often fuels reckless behavior: the illusion of control. This is the sneaky belief that we have more control over outcomes than we actually do. Think about it. You ever bought a lottery ticket, genuinely feeling like this time it was going to be your big win? Or perhaps you've heard of someone investing heavily in a hot stock, convinced they could beat the market or predict its next move, only to see their investment plummet. That's the illusion of control at play. We inherently want to feel in charge, especially when it comes to something as vital as our money. This bias can lead us to take on unnecessary risks, ignoring probabilities and making irrational choices based on gut feelings or incomplete information. We become convinced that our insights or strategies are superior, even when logic and historical data suggest otherwise. It's a dangerous trap, because true financial wisdom often comes from understanding what you can't control and adapting to it, rather than trying to force outcomes. Next up, let us talk about two powerful emotions that often drive us off course: loss aversion and the fear of missing out, or FOMO. Loss aversion is a well-documented psychological phenomenon where the pain of losing something feels significantly greater than the pleasure of gaining an equivalent amount. Imagine losing $100 versus finding $100. The negative emotional impact of the loss is almost always more intense than the positive feeling of the gain. How does this play out in finance? It's why people hold on to losing investments for far too long, hoping against hope that they'll break even. They fear crystallizing that loss, even if selling would allow them to invest in something with better prospects. This can lead to missed opportunities and compounding losses. And then there's FOMO, the fear of missing out. This is a potent cocktail, often mixed with social comparison. You see friends or online gurus seemingly making quick fortunes on a new cryptocurrency, a hot tech stock, or a real estate boom, and suddenly you feel an irresistible urge to jump in. Even if you don't fully understand the investment or it doesn't align with your risk tolerance. FOMO drives us to chase trends, make impulsive decisions, and invest in things we don't truly understand, often right at the peak, just before a correction. It's a classic way to lose money quickly. These aren't the only ones. Our brains are riddled with cognitive biases that shape our money mindset. Confirmation bias. This is our tendency to seek out, interpret, and remember information in a way that confirms our existing beliefs or hypotheses, while ignoring contradictory evidence. If you believe a certain investment is destined to succeed, you'll actively look for news articles, expert opinions, and data that support that view, and conveniently dismiss anything that suggests otherwise. This can lead to tunnel vision and poor decision-making based on incomplete, biased information. Anchoring bias. This occurs when we over-rely on the first piece of information we receive when making decisions. For example, if you see a stock price at $100 and it drops to $70, you might anchor to that initial $100 price, believing it's cheap now, even if its true value is actually lower due to underlying issues. Or, if a financial product is initially presented with a high price, a subsequent discount might seem more appealing than it truly is. These biases, and many others like them, constantly influence our financial decisions, often leading to suboptimal outcomes and preventing us from building the wealth we desire. The first step to overcoming them is simply becoming aware they exist. So, how do we counter these deeply ingrained psychological tendencies and start building financial resilience? Mindfulness and self-awareness. This is paramount. Start by observing your thoughts and emotions around money. When you feel that urge to chase a hot stock or panic sell during a market dip, pause. Ask yourself, is this decision driven by logic and my long-term plan, or by fear, greed, or the desire to control an unpredictable outcome? Recognizing your biases as they happen is the first, most powerful step towards overcoming them. Seeking expert advice, don't go it alone. Working with a qualified, trustworthy financial advisor can be invaluable. They provide an objective, unbiased perspective. They can help you create a personalized financial plan that aligns with your goals, not your emotions, and serve as a crucial sounding board to talk you out of impulsive decisions. Building a financial buffer. This ties directly back to our last episode, your emergency fund. Having a solid financial buffer, along with other savings and diversification in your investments, provides a safety net that helps you weather market fluctuations and unexpected events without making panic-driven decisions. When you know you're financially secure, the emotional sting of a temporary market dip is far less severe. Ultimately, the path to financial well-being isn't just about crunching numbers. It's about mastering your mind. Shift your mindset. Move from a mindset of fear and scarcity to one of abundance and long-term thinking. Understand that building wealth is a marathon, not a sprint, and temporary setbacks are part of the journey. Set realistic goals. Break down your financial aspirations into achievable milestones. Small, consistent wins build confidence and momentum, making you less susceptible to the allure of get-rich-quick schemes. Invest in your financial literacy. Continuously learn. The more you understand about how markets work, different investment vehicles, and your own behavioral patterns, the better equipped you'll be to make rational, informed decisions. Financial education is your best defense against your own biases and the noise of the market. Remember, your brain can be your greatest asset or your biggest liability. When it comes to money, by understanding its quirks and biases, you can take control, make smarter choices, and truly set yourself on the path to lasting wealth and financial freedom. That's it for this episode of Wisemoney. Thank you for tuning in. I encourage you to think about which of these biases you might have recognized in your own financial life. Share your insights or questions in the comments, or connect with us on social media. Be sure to subscribe so you don't miss our next episode, where we'll explore briefly mentioned next topic. For example, the power of compound interest or demystifying your first investment. Until then, stay wise with your money.